All right. Good morning, everyone. It's 7:16, so I guess we'll get rolling now. Um, Government shutdown. Finally, looks like there's some optimism. It looks like we had a Senate bipartisan funding bill. As we've discussed previously, we've only been getting really export inspections to kind of track the business that's going on. Export sales probably will be delayed even if we get a full funding bill passed in the House. Export sales will likely be delayed a couple weeks at least for us to get a full recap of everything that's been traded. I think the last shutdown that lasted just over 30 days took 2 to 3 weeks to get a full list of everything that was traded back during the shutdown time. So likely the first export sales report would be a week from Thursday, and then we'll see how they bring out the old information as we move forward. We do have a WASD on the 14th. That should give us a pretty good recap of at least what USDA is thinking, give us an idea of export sales that have gone on, and then we should get updated state by state production during this. So that'll give us an overall idea of crop size state by state, and we'll talk about it a little bit here as we move forward. Weather, we are starting to run into, some drought conditions in some of our draw territory here in Oklahoma, a little bit in eastern Kansas, but it does look like we have some rain, at least in the forecast here in the short term. And the 8 to 10 day, brings some more moisture possibilities as well as some warmer weather. So hopefully we'll be able to fight back, the drought conditions and not see that continue to decline as we move forward. So inspection pace, I guess the one bit of information we're getting, as you can see, corn inspections remain extremely strong, especially in comparison to previous years. Bean inspections without China in the mix are, way below kind of the 10 to 15 year average here. Um, as we roll into wheat and specifically, this is all wheat. We are above pace. A lot of that is driven by the hard wheat pace we've seen here on the front end, but I think we'll see that start to decline here as we move forward. And lastly, Milo. I mean, we all know without China, not much of an export program going on, but hopefully that changes if we can get some Milo to China on the books. Just another way to look at the inspection pace. This is kind of how we judge what USDA is going to use or what they're going to do on their WASD reports. If we lag behind their seasonal pace to meet their estimate, typically that's when we see them cut or adjust exports down. Or, like in the case of corn, they're already got pretty good sales, but we have a good pace right now. So we could see them make some small adjustments to the upside on corn, or depending on how they foresee this Chinese agreement moving forward, we could see, them leave exports unchanged for everything and adjust on a later report. So let's get into soybeans since this has been kind of the main topic. China committed to 12 million tons or 12.5 million tons for this marketing year to be purchased through November and December. As it sits right now, it doesn't feel like a big Chinese book has been put on. We'll touch a little bit more on that on a future slide, but you can see the commitments then for 26 through 29, 25 million tons a year of beans to be purchased. That doesn't mean executed, just the commitment to buy them. So that could be for deferred slots. It doesn't necessarily have to happen during that marketing year. And when you start looking back through some of our historical Chinese programs, 25 million tons over the next 3 years. Yes, it's a pretty solid commitment, but we've had years like that in the past. So it isn't like an explosive demand structure that will be put into this market. As you kind of look over in the top right, we can see what China has been importing. Basically since March, it's been almost all Brazilian beans, then with the mix of Argentina. So, and you can kind of tell the seasonality of it that Brazil historically, or South America, comes online in March and April with a lot of their new crop beans and become the predominant supplier to China. So when we're looking at the 12 million tons that need to be done this year for 25-26, the window is very small. And when you start looking at, here, I'll go to this slide real quick and we'll jump back. But the bean stocks in China ports on the bottom left, you can see are near a high over the last 5 years. So they have plenty of stocks already in China. It sounds like they have a decent book on with South America. So the optimism that was initially there for a big bean program with this Chinese deal announcement has kind of waned, and a lot of people are questioning when and how they will proceed with these 12 million tons of purchases. One thing I want to note, you can kind of see the green circle. That's the gap that was put in on the soybean chart when China and Trump came to an agreement. We rallied from 1060 up to 1130. But the key is during that same time, Brazilian premiums collapsed nearly $1 a bushel. So we went from the U.S. being extremely competitive into China to now being a discount to South American soybeans into China. So how will this play out? We'll have to watch and see, especially with the U.S. taking themselves out of some of the business they were already doing, and just relying on the Chinese demand to fill out the export pace that we need. A lot of people are questioning the overall balance sheet. If we sit here and look at soybeans and the overall balance sheet, USDA is using a pretty high export number right now of 1685, not quite what we did in 24-25, but a lot of the market is using 1600 or less in their balance sheets, mainly due to the fact that we're not competitive and the Chinese program isn't that big. The other part is how much of the Chinese exports were already plugged into the U.S. balance sheet prior to this deal, and it felt like the 12 million tons was roughly what USDA was using for Chinese exports. So if we lose any of the other destinations, then our outlook on overall exports probably lowers here, and then your carryout probably increases as we move forward. One thing I wanted to touch on the bright side, crush has been extremely strong here. As you can see over the last few years, crush has maintained above the 3-year pace that we have done. On the other side of it, crush margins aren't all that great with the rally in beans. We've seen those kind of tail off of the July and September highs that we had over the last year. So it looks like the crush business will continue to go even with the increased capacity we've seen in that market. But without a drop in soybean prices, crush margins could be at least pressured here in the short run. So let's move into sorghum, the only other commodity that was listed with kind of the Chinese trade announcement. They talked about specific volume of soybeans. On the other side, they did mention sorghum. The big question is going to be how tight of margins and what volume China can import if there is not much in-country margin for them to do it. So some of the past years of Chinese programs where we've seen big programs that premiums just rally. It could be a little bit tougher here if the margin in country is not there for them to continue to just pay increasing prices on every trade. The balance sheets, kind of the Chinese combined feed imports, USDA has 10 million tons of corn. They've got Milo, everything baked into that import number for China. That isn't only US, that's, every origin. But the question is, are they actually going to import that amount of feed grains as a whole, or is that overstated for 25-26? At the end of the day, what it comes down to is, USDA's got 225 baked into their export number for sorghum. And as we've talked about previously, without China in the mix, we're probably 100 million or less in total exports. And even if we do get a pretty solid export program to China, with how the pace is at this point, it's probably pretty similar to 2019 or 2020, where we hit 100 and 150 million bushels to China. So that would take our total export number, somewhere around 175 to 200. And that still gives us a very comfortable carry out in sorghum. So I think we'll have to stay competitive to keep that program rolling if they do come in for volume. So let's go into corn. We're going to get a good look at the corn balance sheet on the WASDE report and updated production. The biggest thing here is the export number. Can we continue this pace of exports for corn? I think the market's using a slightly lower export number than USDA. So our balance sheet is very comfortable in corn. And when you look regionally in the West here, our corn stocks are very comfortable as well. So to expect big fireworks out of the corn market, at least in the short run here, I don't expect any big fireworks. I mean, the balance sheet can handle a drop in yield, which I think most of the market is expecting from the last USDA report. And, our balance sheet stocks to use, even if you use a 180 carry or 180 yield, you still have a stocks to use ratio, near 11.5%. So very comfortable as a whole. So we'll just need to continue to watch the corn export sales once those start coming back online, and the inspection pace to see where that end export number is actually going to land. So let's go into wheat. We've seen a very good rally in wheat here. I wanted to touch on world prices. So 2 weeks ago, hard wheat was very competitive on a FOB to FOB basis in the world. When you start accounting for freight, we're not that competitive outside of kind of our core routine demand areas. But after this recent rally, you can see hard wheat rallied nearly $10, $11 a ton. The rest of the world stayed pretty much unchanged. So now we're uncompetitive into some markets that we've picked up, mainly, like Nigeria, any of the stuff that we've done into Northern Africa, and then some of the other markets like Venezuela, even Mexico today. You could probably price a different origin depending on quality to work into some of the boat ports. So our optimism for maybe 350 in exports probably drops off here, and we start working our way back into, more of a residual supplier to the world and only our key routine destinations. So as we move into the balance sheet, our export number, I was using 350. I dropped that down to 335. So stocks to use ratio above 50%, very similar to what USDA is using at this point. So unless we see a big price drop that the world does not react to, it's going to be tough for us to probably hit 335. And as we move forward, it just increases our carry out as we move forward. One of the things we have seen here recently is the spread curve narrowed up. Part of that's been tied to the domestic market needing cars. A lot of theories on why that has occurred, but looks more like a logistic and timing issue, especially when you sit and look at the Gulf market. Really hasn't changed much, even with increased secondary freight. So I expect that spread curve to widen back out as we move forward through the month of November. So let's go into price changes. Last week, pretty calm markets in comparison to the prior week. The big moves were done right on the Chinese announcement, and then have kind of settled off and leveled into a smaller trading range. So as we start looking at soybeans, we've all seen the move from 1060 to, nearly 1135. That went through kind of all the price objectives we had from a couple weeks ago. I still think you take advantage of the rally. The U.S. not being competitive in beans and there being a big gap in the chart, there's an opportunity that if we do start making a move lower in the board, that we take 50 or 60 cents out of this before, finding another leg to move back towards $11 beans. So I think you take advantage of this short term if you have some old crop beans to sell, and then, look for another opportunity. I don't see us, with us being this close to South American new crop beans, that, we're really going to see a big enough export program to tax the balance sheet at this point. One thing I did want to note was the daily trading ranges on the bottom left. For the last 3 months, volatility has been incredibly small. Small trading ranges, nothing big there. And then you move over to the last 10 days and the trading range jumps incredibly. So a lot more volatility in this market. A lot of the option strategies, for farmers are more expensive today. Doesn't mean that we shouldn't use them. It just means, they're probably going to be more expensive than if you quoted them 2 or 3 weeks ago. The other thing to note on new crop 26, you can sell above $11 beans out there. So if you have guys anticipating planting beans, I would at least take a look at the 2026 values out there and, know what our break-even costs are and maybe look at doing a small percentage of those. The wheat price outlook, same thing. Take advantage of this rally if you have some old crop wheat. We're pricing ourselves out of export demand. As we sit today, there aren't any big issues in the world, or at least drastic issues that are going to affect the overall world balance sheets. So I think you take advantage of this. I mean, we're trading 50 cents off of our recent lows and, kind of hit some of the price targets that we had, at least on the short term. July 26 and 27 still have some good opportunities out there. I think, we need to be proactive marketers and take advantage of these rallies when we get them and reward that rally. So if you have guys who know they're going to have wheat, at least take a look at the 26, 27 prices. So for corn and milo, we've kind of, we finally filled the gap at 429 to 434. That had kind of been a price objective for the market to fill that gap. We traded up to 435, a little bit higher for a short amount of time, and now we've kind of consolidated into this range between 420 and 430. I think if you have some old crop milo or corn, 430 and above, at least here in the short term, it probably is a pretty good selling point. Our corn carryout, unless USDA does something drastically different on the upcoming WASDE, to trade above 430 with this kind of carryout in both corn and milo just doesn't look too optimistic. So I think you reward this rally as, all the rallies for corn, beans, and wheat. I think the farmer needs to reward those rallies with farmer selling. And we have seen it on the river and, around the rest of the country that, we are buying commodities during this rally. D's 26, same thing. These carries in the market provide good opportunities for 26 new crop, trading near 470. And as we sit here this morning, we're at 467. But, I think if you're going to plant milo or corn next year, it's a good opportunity to at least start marketing going into next year. The one thing about carry markets, the next futures month always looks to trade to the recent trading range of the front month. So, if D's right now, D's corn is trading in the 428, 430 range, and, March is sitting there at 444, you're likely going to see March trade to the recent trading range for the December. So, and as that happens, then you're going to drag the back end part of that curve down, and your marketing opportunities then, become reduced as we move farther along in this marketing year. If you have any questions, any farmers have questions, contact your local RMA. Here's Mike Hellman's number. If you guys need something, contact him or any part of his group.